Retirement is a phase of life that all people look out to. It is where we can finally enjoy the fruits of our labors after years of toiling and hustling. Retirement is the time to finally benefit from all those years of hard work. Thus, if you want to be financially prepared for your retirement, planning and strategizing is a must. You should save and invest as early as possible so you can have enough nesting eggs to sustain yourself during your retirement. There are various financial tools developed to aid your financial preparation. One tool developed in the US is the 401k plan. A 401k plan is a company-sponsored retirement account where employees can contribute income and employers match these contributions. It is a retirement savings and investing plan that employers offer, which also gives employees a tax break on the money they contribute. Hence, experts really recommend for you to utilize and maximize this option given. Some people, however, find it challenging to open and maintain a 401k account. With economic hardships brought by the pandemic, it is tempting not to contribute to free up some cash in case something happens. In addition, the war in Ukraine and Russia also poses another challenge since it fueled up inflation worldwide. Some decided to cash out from their 401k accounts just to get by or to fund a major purchase or emergency. This is a mistake. In this video, we will talk about the 7 financial mistakes that beginners make with their 401k accounts that could cost them their retirement. We will discuss these mistakes one by one to help you better understand your 401k accounts and how you can make better financial decisions. So stay tuned and make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Number 1. Not making use of a company match. One of 401k's best features is that your employer can match your contribution. When you contribute to your retirement account, your company can also contribute the same amount for you. This is basically free money. Thus, if your company is willing to contribute up to 6% of your salary, take advantage of this and contribute at least 6% of your salary as well. If you don't do this, the money will just go back to your employer. So maximize your 401k contribution to also maximize company matching. With this, you can easily double your savings for retirement. However, please look out for vesting as well. 401k vesting represents how much of the employer-contributed funds you own in any given year. There are instances where you cannot own the matching contributions if you leave your employer too early. Hence, look out for this before you decide to transfer to a new job. Make sure you've fully vested before transferring so as not to waste those matching contributions. Number 2. Remaining stagnant with your contributions. Always remember that 401k contributions are based on a percentage of your salary. Hence, the higher your salary becomes, the higher your contribution should be. Unfortunately, some people do not do this. Their 401k contributions remained the same over time even if their salary had shot up. If you want to achieve financial freedom and independence sooner, then increase your 401k contribution when your salary increases as well. While it is tempting to spend your extra money on other things whenever you get a salary increase, remember that investing more in your 401k plan will eventually bring you a greater return when you retire. Hence, avoid not increasing your contributions over time. Number 3. Cashing out when changing employers. When changing jobs, most 401k holders tend to cash out from their accounts. Early withdrawal is not recommended because it comes with hefty penalties. Plus, there is also a large tax implication if you cash out early. If you are required to move your money when you switch jobs or leave a company, why not do a rollover instead? Transfer it to an IRA or into a new employer's 401k plan. If there is a direct rollover, take advantage of this as well. This will give you little chance to cash out and spend the money. Number 4. Cashing out. Cashing out, just like we've mentioned earlier, is not recommended at all. Do not take money out from your 401k just to fund a major purchase or travel. This could be the worst financial decision you can ever make for your financial future. Yes, it can be tempting, but remember that it can have a huge negative financial impact on you, which you may regret later. Cashing out early means hefty penalty fees and a big tax burden. What is worse is you can also miss out on compound interest. Remember that in investing, time is key. Compound interest is what will make your money grow quicker. The more money you have invested earlier, the more it can grow. Hence, take advantage of time. Unless it is an emergency, do not take money out from your 401k. Try to exhaust all your other options. Also, try to fully fund your emergency fund so you won't have to turn to your 401k to finance these possible scenarios. Before we move on to the next one, if you're new to the channel, kindly give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. Now let's continue to the next one. Number 5. Not checking your investment performance. When you open a 401k account, you'll have the option to choose where to invest the money. These options may vary depending on the level of risk. Pay attention to the performance of these investments and compare it to the overall market. Remember, your returns depend on how your investment and the overall market are performing. If your investment portfolio averages 10% per year, over time it could also give you greater returns compared to that investment that averages only 5%. Hence, compare your investment fund to other similar funds to see how it is performing over the same period of time. For instance, if you have a small cap fund in your investment portfolio, try to compare its performance to the S&P Small Cap 600. If it is underperforming, then there is no reason for you to hold on to that. Take note that you cannot get your money back if your portfolio ends up losing, so divert your extra cash to other investments instead. Number 6. Concentrating on only one or few company stocks. Diversifying is perhaps one of the most basic pieces of advice in investing. Sometimes it already sounds cliché, right? However, let me say this. Do not allocate too much of your investment portfolio to one stock only. Some 401k account holders tend to keep much of their portfolio on one stock only, and this is dangerous since you might put your retirement money in jeopardy in case something happens to that company. Employers tend to limit their stocks only to their company, but what if it goes bankrupt in the coming months? Not only will you lose your job, but you will lose your retirement money as well. Experts recommend only investing 20% or so in index funds or ETF in a portion and individual stock. The rest should be spread out to other funds. Number 7. Not understanding the downfalls and alternative choices. Another mistake that 401k investors make is not being aware of the downsides of the market and the alternative choices available. You have to understand that 401ks, just like any other investments, are not perfect. It is essential that you understand that. There are various options for you to choose from on where you want to invest your 401k funds. You need to be aware of this so you won't limit yourself only to a few investment selections who you might be paying a higher fee to compared to others. Be aware of these fees because it could make a dent on your retirement savings. Even those with only 1 or 2% will eventually add up and eat away some of your money. Another reason to consider why you should spread out your investments is tax diversification. If you're interested, you can invest in individual stocks through IRAs. This can be an advantage since you won't pay any taxes on those funds during your retirement, unlike 401k's disbursements, which are taxed. Taxes on your investments will ultimately depend on your income bracket during retirement. Hence, if your income by then is higher and is coming from a 401k alone, then you should expect a higher tax bill. And those are 7 mistakes that beginners make with their 401k's investments. Always remember that committing these mistakes could financially jeopardize your financial future. Retirement should be sweet, so don't spend it regretting over the financial choices you made today. Let us know your thoughts on this video in the comment section below. We'd love to hear whether you agree or not on the things we've discussed. With that being said, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!